Happy Tuesday, everybody. I hope you had a great Labor Day weekend. I'm sorry to report it is the unofficial end of summer. As we move into the final 4 months of the year, I will continue to keep you informed with these videos and much more. Today is September 6, 2022, and this is your Tuesday market update. Let's jump right into a recap of last week. Monday was met with continued selling from the major sell-off from the previous Friday. Stocks did gap lower. Not much news over the weekend except for more digestion or indigestion from the Powell speech from Friday. We know that expectations for a dovish turn is what moved this market from its June lows to its August highs, but Powell threw cold water on that. Why were we surprised? As I've been saying, the Fed has actually been pretty clear, even as Fed speak goes, but no one wants to hear it. It's a pretty concerning time when there seems to be a full disconnect from what the Fed heads are saying and what the market expectations are. There are few opinions as to that the Fed continues to talk down the economy. The bullish wisdom is that the market is already priced in that economic slowdown. This, of course, remains to be seen. Very little waves made on Monday. Oil did rally 4%. Why? Well, we can say it was Musk saying we need more fossil fuels now, or Libyan conflict. Overall, Dow and S&P were down about 0.5%, and the NASDAQ was down about 1%. We're still debating the recession definition. Recall that we've spoken about one of the historic leading indicators being the inverted yield curve. Well, in case you're wondering, the 10s have been inverted now for 10 weeks and counting. Stocks did open slightly higher on Tuesday, but that was short-lived. Geopolitics got into the action with Taiwan firing warning shots at a Chinese drone, and overall negative tone persisted. Stocks got hit again with selling after the JOLTS report came out. Expectations were for 10.4 million jobs available, and the number was over 11 million, almost 11.25 million jobs. This matters since one of the two Fed mandates is to keep the jobs market in check. As it does not do well for the soundbite, the jobs market is too good as of now. That drives wages up, and that drives inflation. And just to remind you, in case you've been hit under a rock, the Fed is fighting inflation aggressively. A few Fed heads repeated the same old song, and the markets rolled over to new lows in the afternoon and closed just off the lows, all three indices down about 1% on the day. Going into the last trading day of August, the S&P 500 has given up half of its 17.4% bounce from the summer low. NASDAQ gave up about 10% from the 23.3% gain from that June low, and that was before the September-October volatility comes in the next couple of months. Year to date, 87% of trading days have seen a 1% swing or more in the S&P. Only 45% of the trading days this year have been positive versus the average of 52% of days. Once again, stocks opened higher on Wednesday. The ADP report was a bit below expectations. The market did like that, as the market does prefer to see the labor market cooling, as we've said. We did get a Fed head, Mester, who spoke before the bell and said it again. They will be aggressive with inflation. She actually said that that higher for longer was possible, and even at the expense of the economy. She even went as far to throw cold water directly on the pivot idea. Quote, "I do not anticipate the Fed cutting the Fed funds target rate next year." Close quote. Other than that news, things were pretty quiet on the news wires. Stocks bled lower without anything positive to add. Overall, the Dow was down just under 1%, the S&P down about 0.75%, and the NASDAQ down about 0.5%. We're getting back to the signal and the noise. If you remember that focus from a few months ago, there's a lot of noise, most of it correctly focused on the Fed and inflation data. Thursday opened a bit on the heavy side on the heels of the zero COVID policy in China, bringing one of the larger cities, 21 million people, to lockdown again. And no, I will not try to pronounce those city names. I'm sorry. There was hawkish eco data from Germany. U.S. jobless claims continue to fall, and ISM manufacturing data was in the good news is bad news camps. Resilient growth, thus there is more room for the Fed to stay hawkish. Encouraging data point that was pretty much ignored, as that the prices paid component of the report did drop a bit. Any anti-inflationary? Don't know. The S&P 500 faded until it ran into the 3,900 level. Then it held that technical level. Friday brought the all-important non-farm payrolls number, and they were pretty close to inline, 315,000 versus an expected 318,000. This, along with the rising unemployment rate and rising participation rate, even the hourly earnings rate of growth slowed. So many saw this as a Goldilocks report. The market was up from the open and slowly faded until the empty desk seemingly gave way to the algos, and the stocks reversed course and went down. The Dow erased a 370-point gain to end lower by nearly 338 points, or 1.1%. The S&P 500 also fell 1.1%, and the NASDAQ was down in line with that, Dow down 1.3%. Again, note how close everything was to closing times. Computers, maybe not people. As I said, so many people were already away on vacation. For the week, the Dow and the S&P were down about 3%. The NASDAQ was down a little over 4%. 3 losing weeks in a row for the market. Overall, as I mentioned, the September-October months are historically the most volatile of the year. Let's preview the coming holiday shortened week, and I'll end with a couple of facts about September and end on a positive note. This week, as most post-jobs weeks are, is going to be slower for data. We'll have PMI reports as well as the Beige Book that may shed some more light on things. Last month, we heard that the consumer spending had moderated. We will get jobless numbers on Thursday, as usual, and a whole host of Fed heads. Wednesday, we'll hear from Mester, Brainerd, and Barr. Thursday, about Powell. It'll all be about Powell. Friday, Evans and Waller will put their 2 cents in. While we'll see the return of traders post-Labor Day, the eco data is slower. We will deal with news from the weekend with OPEC Plus production cuts, as well as the Nord Stream 1 gas pipeline news. As always, we'll have to see what this brings. As I mentioned, courtesy of LPL Research, here is some data on September. Since 1950, in September, the S&P 500 has averaged the worst of all the 12 months moves. In the past 20 years, also the lowest return for a month in the year. In the past 10 years, September is the only month with the average monthly loss for the S&P. And for midterm years, it ranks 9th, better than January, May, and June. So where's the positive note I mentioned to you? First, when we were describing the volatility in the past months, just recently, in terms of 4 and 5% moves at a time, the average decline in September since 1950, about 0.5%. And more positively, October's right around the corner, and in midterm election years, the best 3 months have been October, November, and December. So overall, we'll keep you informed as things move along. Please stay in touch. Be sure to come back for special informative videos, as well as the weekly Friday planning video. We'll continue to focus on your longer-term goals and what actions, if any, should be taken as we approach the fourth quarter. Have a great week.